Let's talk about everyone's favorite subject, taxes. If you make decent enough money here in Canada, or maybe if you don't, you'll still realize that CRA takes quite a bit of what you've earned. And today I'm going to go over some strategies that you could apply, put in place that will help you and your family save money. Now, this is not an exhaustive list, but I think people's attention span are limited to a certain amount of time when taxes are involved. So I'm not gonna go through a whole long list, but I'm gonna go over quite a few that I think most people can apply. All right. So let's start off. Let's start off by something simple, and this is just the power of strategic expense management. And what that means is you have a higher income spouse, they pay the expenses, and a lower income spouse invest. And when we talk about investing, it could be investing in stocks, bonds, or other income producing assets. But because you're in a lower income, when they go to pull from those assets, or even if they're taxed throughout the year, they're going to be taxed at a lower rate because they're a lower income spouse. So that's one strategy that you could put in place, and one thing that you can consider. Another one is, and a quite popular one, I think, at least it should be, is a TFSA. And the advantage here is if you're a higher income spouse, you could gift a certain amount to your lower income spouse. Quite frankly, you could gift up to the actual limit that your spouse has for that year, and the money grows tax-free. And a lot of times where you see this applies for the higher is where the higher income spouse has already maxed out their room and they're looking for, somewhere else they could put funds to have it grow tax-free. Of course, if your lower income spouse has space, that is a great opportunity, and you could max out his or her TFSA there. Now, one important caveat: if the spouse later withdraws, this is the lower income spouse, withdraws the funds and reinvests them outside of TFSA, any income on those, if it's withdrawn, could be attributed back to the gifting spouse, so you want to be careful of that. But that aside, it's a great opportunity, and the benefit here is that you don't have attribution rules. What are attribution rules? If you simply gift cash or income or some type of asset to your spouse, and the spouse later have that invested and it grows, and you take money out within a certain period, it gets attributed back to the spouse with a higher income, right? But here's a huge benefit that with TFSAs, it allows for money to go tax-free with that one caveat. Next one is if you're a business owner, and as you know, this channel is dedicated to business owners, you could turn your family business into a tax-saving machine. And of course, there are limits to that, right? So identify real work, hire a family member, pay them reasonable wages, claim the deductions because it's a salary. And in many instances, this family member, if they're in a lower tax bracket, will have lower personal rates versus you earning it at a higher rate and then giving it to your family member, right? Now, there are some limitations to this and some requirements. You want to speak to your accountant and financial advisor, making sure that you are aligned with them. But generally speaking, this is a great strategy. And this is why you have so many family businesses hiring their family members. Another one is the spousal RSPs. So how this works is a higher income spouse makes contribution to the spousal RSP. Huge benefit here is a contributing spouse, which is a higher income spouse. They get to claim the deduction, and the funds grow tax deferred in the RSP of the spouse who received these funds, who is a lower income spouse. And here's an added benefit from a retirement standpoint. It's effective because it allows for income equalization. What does that mean? It ensures that both spouses have similar income levels and minimizes the overall family's tax burden. So for example, if you have a high income spouse and this person he or she never made the contributions to the lower income spouse and keep all that investment, all that wealth, once you get to retirement, you have certain mandatory things that have to come out, like a RIF, where a certain amount has to leave and is taxed as ordinary income. Or you may have non-registered funds also. The bottom line is, by pulling and drawing from those assets in the latter years, what will happen is you will be, if you're taking quite a bit, in a higher tax bracket. Whereas if some of those funds were in your spouse, who's the lower tax bracket, he or she would be taxed at a lower rate. So this gives you opportunities for one, benefit from tax deductions now, and having that funds grow tax deferred, of course, it's one of the benefits in RSPs, but in the latter years in retirement, it helps to, equalize the tax burden as opposed to having it on one, which is the higher income spouse. Another thing that you could do is, we know about a home buyer's plan, and the spouse can withdraw up to $60,000 tax-free from their RSPs to buy a home. And more recently, we have had the FHSA, which is the First Home Savings Account, similar to how the TFSA works, where you could contribute to your spouse, a lower income spouse. You could do the same for FHSA, especially if you've maxed out your room. You could contribute to the other spouse's FHSA, and the benefit there is that the funds grow tax-free, and you could use that to purchase for a qualifying home. And there are, of course, restrictions around what's a qualified home. I'm not going to get into details about that. That would be for another video. But the benefit here is that, once you've maximized space and you're looking for additional accounts, additional strategies to have funds grow tax-free, the FHSA is a huge benefit here, especially where you're saving for a home. And the other important thing is that attribution rules don't apply. Another one is the RESP. So you contribute to the RSP, it grows tax deferred. You have the benefit of grants and bonds, and a certain amount is given to you depending on your income and depending on your situation. But here's a huge benefit: it grows tax deferred. But when the child, your kids, go to pull from those funds, in most instances, what you're going to have is your child is going to be in a lower income tax bracket. And so, yes, there are taxes, but it's going to be lower. Versus if you kept it, you invested it yourself, saying something that's non-registered, and you're in a higher income tax bracket. And then you also go to pull funds to put towards the RESPs, that would also be taxed at a pretty high rate. And so the benefit here is that even though you earn these funds, you put it into an account, have it grow over the years, the benefit is that an individual member of your family, here we're talking about your kids, is able to get access to those funds, but at a lower tax bracket, even though you're the one that contributed to it. So not a huge benefit. Let's stay on the topic of kids. One of the things is you probably want to start showing your kids or teaching the kids about investment opportunities. If you transfer cash, let's say cash here, and you transfer cash to your kids, and they invest in an asset that has capital gains, there's 0% attribution rules, which means that legally, even though the kids have ownership, especially for long-term growth investments, what's happening here is that it grows, and then when they do pull the funds, it's not attributed back to you, the parent. When I say attributed back, I mean the taxes are not attributed back. It means you don't have to pay, right? There's certain instances, for example, if you've given funds to your kids and those funds goes into producing dividends, it'll be attributed back to you, the parent, right? So what we're talking about here is that with capital gains, there's 0 attribution rules. So you give money to your kids to invest in assets that produce capital gains, you are protected, not a benefit. Another strategy, CPP benefit splitting. You have a salary, and say the higher income spouse contributed more and have a higher CPP amount. You could elect, if you file your taxes, you could file to equal, and you could file to essentially equalize that aspect of retirement income between the partners. There's also pension splitting. So those are things that you can consider. So here's some strategies. Those are some more popular strategies. There's a bunch more, but I think those are ones that are equally applicable to a wide range of individuals, and a good place to start. And quite frankly, if you want to know, or if you want to think about tax planning, this is what it looks like. Review your situation, identify opportunities, some of which I've spoken about today. But of course, again, there's a longer list. Speak with your professionals. A lot of times what you're going to be doing is working with professionals, whether they be tax professionals, financial planner, and then you start to implement and you monitor and adjust, because each year, depending on your circumstances, things may change or opportunities may come about. Hopefully this was helpful. I know taxes can be quite the challenging and daunting task to even think about, but I also know that it costs quite a bit. And so hopefully this was helpful for you. next week I'll come back with some other strategies to help Canadians better themselves from a financial standpoint to take advantage of whatever opportunities or strategies are available.